from BlackRock iShares is Del Stafford, Managing Director and Global Head of iShares Product and Investment Consulting. From MSCI, we have two experts on the call, Diana Tidd, Managing Director and Head of the Index Business for the Americas, and Dimitris Melis, Executive Director and the firm's Global Head of New Product Research. I'm extremely excited about today's webinar because it drives at the core thing that I love about ETFs. ETFs, ultimately, are tools that help investors and advisors build institutional caliber portfolios at extraordinarily low costs. If you look at the history of product development in the ETF space, a lot of it focuses on exactly that. And the two firms that have been pushing that innovation more than anyone else are BlackRock and MSCI. As with last week's webinar, today's session does not follow our usual format. Typically, a member of the Index Universe team will present research and findings to set the stage for a moderated Q&A. For this webinar, we're going to turn that on its head, handing the floor to BlackRock and MSCI, and letting them present their latest thoughts and research on the topic for the first 30 to 40 minutes. We will then close with 20 to 30 minutes of moderated Q&A. As a participant in this webinar, you're invited to ask questions of me and my panelists using the Q&A tool at the bottom right of your webinar browser. Please don't wait until the end of the webinar to ask questions. Ask them throughout the webinar as they occur to you. We will collate the questions and answer as many as we can during the Q&A session at the end. We always get asked this by participants, so I'll say it up front. A recorded version of this webinar, along with the slides, will be made available on indexuniverse.com a few days from now. As a participant in this webinar, we'll alert you by email when those slides are posted. With that, I'm going to turn it over to Del to get us started. Del?
Thanks, Matt, and thank you to everyone for attending. Over the next hour, we will seek to accomplish the following objectives. Provide an introduction to MSCI, not just an index provider, but a global leader in institutional investment decision support, ranging from risk management and portfolio construction software to forensic accounting support. MSCI will provide a review of their index construction methodology with particular focus on the important distinction between developing economies and developing capital markets. Often our knowledge of products countries produce, such as cars, electronics, those cities that are growing, can influence our beliefs of its developed status. But as investors, a well-functioning, self-contained, evolving capital market is crucial. MSCI will discuss why this matters to you and advisors stewarding client assets. And then we'll wrap up with a discussion on selecting the right international exposure in an expanded solution set. We believe individual choice is paramount for building portfolios. There are differences in index exposures, especially among index providers. Institutions and advisors alike are demanding access to new markets and new exposures to build highly customized, risk-controlled, diversified portfolios in the current environment. To this end, we'll discuss the case for expanding into small cap international through IMI, the untapped markets, frontier markets, and then lastly, minimum volatility indices, an approach that is well established with institutions and a frequent request among financial advisors today. With that, I would like to turn it over to Diana to provide an introduction to MSCI. Diana?
Thank you, Del, and thank you to Index Universe for hosting this event. For the participants, we hope any of you and your families hit by the storm on the east coast of the U.S. last week are safe and warm. We appreciate all of you joining us today. I think it would be helpful to take a minute up front to explain a bit about what MSCI is all about. As you can see from our brands listed across this page, MSCI is more than an index provider. We provide world-class, mission-critical investment decision support tools. We've been at this for quite a long time, 43 years, and our tools are embedded throughout the investment processes of our clients. In our index business, we focus on transparency, accuracy, and replicability, which includes minimizing unnecessary turnover in our indices, which can add costs to running a portfolio. For these reasons, we're chosen as a performance benchmark and the basis for structured index products. Our BARA and risk metrics analytics tools are used in portfolio construction, risk management, and client reporting by top institutional investors. Our governance tools and ESG products are core to many investors' processes. Across the many businesses you see here, there are 6,200 clients in 82 countries who have chosen MSCI as their service provider. These include institutional asset managers, financial advisors, third-party managers, banks, hedge funds, investment consultants, foundations, endowments, and pension funds. In fact, pension funds are particularly relevant here as pension funds are quite smart and sophisticated in their benchmark selection. With the large sums of money they run, pension funds adopt very high standards for index selection. Often, to choose their index provider, they do months of research and analysis, and they look at all of the competitors in the marketplace in order to ensure they're choosing the best index provider. The final decision very often requires approval from their board. The vast majority of these and other institutional investors have consistently selected MSCI as their international equity index provider. As a result of the trust investors put in MSCI, we have close to $7 trillion in assets benchmarked to MSCI's indices. We're the #1 benchmark provider for institutional pan-European funds. 95% of U.S. pension funds assets invested in international equity are benchmarked to MSCI indices. And finally, Intersect reports that 100% of new money that U.S. pension funds invested in international equities, according to their definition, in the first half of 2012 was benchmarked to MSCI. That's 100% using MSCI. Before I pass this presentation over to Dimitris in our research department, I'll say a few words about our research department since it's really core to MSCI's value proposition for our clients. Our research team is large, and we have team members located around the world. In fact, MSCI is quite global with 2,400 employees in 29 cities in 20 countries. MSCI's research and data teams speak 15 different languages altogether. And so why is that important to you? Well, it's quite important, I think, because our teams can interact with local markets in local languages. MSCI talks to local authorities, we speak to exchanges, and other market participants to best understand the realities of investing in those local markets. We know what's happening in the markets, and we understand their capital market structures. But I'll add that after 43 years of calculating indices, we've learned how important it is to understand the actual experience of our clients in these markets. Therefore, before making any significant changes to our methodology or market classification, MSCI consults with our clients beforehand. So we talk to our clients well before, not after, making these changes. We know from our clients that they prefer not to be surprised, and so again, we speak to them before we announce any changes. With that, I'll pass it to Dimitris to talk further about our indices.
Thank you very much, Diana. So what matters most to investors when they select an index, and how does MSCI go about meeting those requirements that investors have? Well, actually, two things matter most to investors when they select an index: accuracy and investability. First, investors want their index to be an accurate and timely representation of the specific equity market the index claims to represent. MSCI addresses this investor requirement for accuracy by having a transparent methodology and a robust market classification framework. These important elements ensure the index reflects all investment opportunities without gaps or overlaps and captures changes in markets in a timely manner. Second, investors want their index to be investable and replicable. MSCI addresses this need for investability mainly through three important elements of the methodology. First, we make extensive use of buffer zones, aiming to reduce turnover and keep replication costs low. Second, we ensure that corporate events, such as mergers or acquisitions, are implemented in the index in a timely manner and also in a way that can be replicated in actual portfolios. Third, we use different liquidity measures to ensure that the stocks that are included in the index are actually investable. So by focusing on accuracy and investability, MSCI indices are widely recognized as objective measures of markets, fair benchmarks for managers, and cost-effective solutions for index replication. Turnover and replication costs are very important components of portfolio costs. In fact, higher index turnover means higher portfolio turnover, which would imply higher transaction costs. So why should you care about transaction costs? Well, because they reduce the net return that is available to the investor. For example, under certain assumptions, a 10% increase in index turnover could lead to a 5 basis points reduction in index performance. 5 basis points may sound like a small number, but this is actually significant, especially in the context of index tracking portfolios. MSCI limits unnecessary index turnover and reduces replication costs by making systematic use of buffer zones in the methodology. In fact, we recently simulated the so-called packeting approach that has been suggested by new index providers. Our simulations show that this packeting approach historically led to 28% higher turnover and significantly higher volatility in the number of index constituents compared to our methodology that uses buffer zones. In addition to extensive use of buffer zones, MSCI also has extremely low error rates in the reinvestment of dividends and also in the implementation of corporate events. These extremely low error rates further reduce unnecessary turnover and help to keep replication costs low. An important element of the MSCI methodology is our market classification framework. And here on this slide, you can see how MSCI has captured the evolution of markets over the last 4 decades. In fact, MSCI was the first index provider to launch international equity indices back in the late 1960s. And since then, MSCI has expanded the breadth and the depth of MSCI indices over time, really reflecting the evolution of equity markets and also the evolution of the institutional investment process. For example, MSCI launched emerging markets indices in 1988 and frontier market indices in 2007. So as I mentioned, an important element of the MSCI methodology is our robust market classification framework. This framework classifies markets into 3 categories: developed, emerging, and frontier. The classification is done by assessing 3 criteria: economic development, size and liquidity of the equity market, and very importantly, market accessibility. It's also important to point out that market classification our market classification framework reacts to changes in markets and reclassifies markets when they meet the appropriate criteria. So over the next couple of slides, we will discuss in detail the classification of 2 specific markets, Korea and Pakistan. Now, when it comes to market classification, perception can be very different from reality. Anyone who has traveled to Korea will testify that it looks like a developed economy. The Seoul night sky is lit by neon lights advertising many different consumer products, many of which are produced in Korea. In fact, many of us in the United States and around the world buy Samsung cell phones, LG televisions, and Hyundai automobiles. However, before we reach a conclusion based only on anecdotal evidence, why don't we take a closer look at the numbers? In fact, the bar chart that you see on the right of the slide shows various countries ranked by gross national income, GNI per capita. This chart confirms that Korea is very close to other developed markets with respect to GNI per capita. However, it is also important to highlight that despite the consumer products it produces and the world-class companies it has, Korea ranks at the bottom of the list compared to other developed markets on this particular measure of economic development, GNI per capita. However, even if we accept that Korea is a developed economy, it does not follow that it is also a developed capital market. In fact, MSCI classifies Korea as an emerging market for two very specific practical reasons. The first specific practical reason is what we call currency non-convertibility. So what does this mean and why does it matter to investors? Obviously, when an investor wants to invest in Korean stocks, first they have to buy the local currency. And in fact, for every other developed market around the world, investors can very easily buy the local currency 24 hours and around the world. So investors can very easily invest in Japanese companies and buy the yen, in British companies and buy the pound, in German companies and buy the euro. And they can do this this currency transaction, in all major financial centers 24 hours a day. However, investors face significant difficulties when they want to trade the Korean currency outside Korea and outside local business hours. So this so-called currency non-convertibility does create significant impediments for investors who wish to invest in Korean stocks. The second very specific and practical reason why MSCI classifies Korea as an emerging market is absence of in-kind transfers. Again, what does this mean and why does it matter for investors? Well, very simply, investors are unable to transfer shares between different accounts in Korea. This makes Korean portfolios operationally more difficult to manage. And more importantly, lack of transferability also increases the cost of managing portfolios. Another example of how the MSCI market classification framework provides timely and accurate classification of markets is Pakistan on the next slide. Pakistan was first included in the MSCI Emerging Markets Index in 1993. Then MSCI removed Pakistan from the Emerging Markets Index in 2008. And this removal was really triggered by the imposition of what was called a price floor rule on the Karachi Stock Exchange in August 2008. And essentially this rule effectively closed the equity market for 5 months. This floor was subsequently removed and trading resumed in early 2009, but market levels collapsed. As a result, Pakistan did not fulfill the size and liquidity requirements for emerging markets. MSCI now classifies Pakistan as a frontier market. So here the question we're asking is it appropriate to reclassify Pakistan from frontier to emerging markets when only 4 years ago the authorities effectively closed the stock market for 5 months and prevented investors from withdrawing their capital? So these were two specific examples of markets and how they're classified by MSCI. Moving on to the next slide, we highlight an important institutional investment trend. What we have seen is that globalization of economic activity and increased integration of capital markets have recently led investors to rethink their equity investment process. As asset growth is the main objective of equity allocations, biasing it towards the domestic market may come with potentially huge opportunity costs. And in fact, many large and leading global pension funds are shifting from their traditional domestic versus international divide towards an integrated global perspective for their equity portfolios. Essentially what we're saying is that the full equity opportunity set spans the globe and is the natural starting point for equity allocation. A representative benchmark or index must be similarly broad but still investable. The MSCI ACWI IMI index, the All-Country World Investable Market Index, contains both developed and emerging markets and also covers all capitalization segments, large cap, mid cap and small cap. An increasing number of institutional investors are adopting the MSCI ACWI IMI as their policy benchmark. So as we mentioned earlier, investors increasingly recognize that the natural opportunity set is a broad yet investable global equity index such as the MSCI ACWI IMI. And here on this slide we highlight potential reasons why institutional investors have included small caps in their global equity portfolios. These include historical small cap premium, better diversification potential, wider opportunities, more access and lower cost. Because of higher returns to small caps across the globe during the last decade, the MSCI investable markets indices earned higher returns and higher return to risk ratios than their large and mid-cap counterparts. For example, you can see some statistics in the table here on this slide. In the last 10 years, the MSCI ACWI IMI earned 0.5% higher annual return than the MSCI ACWI index, with only 0.1% higher annual volatility, resulting in superior absolute as well as risk-adjusted performance for the ACWI IMI index. And in fact, this analysis here, the data in this table, shows that this outperformance of IMI indices compared to standard indices was consistent across most regions and markets in the last 10 years. As I mentioned, we have observed an important structural trend in the institutional investment process in recent years. This trend is the increasing adoption by institutional investors of global indices as policy benchmarks for their equity portfolios. This slide shows a sample of large institutional investors that have recently adopted the MSCI ACWI or ACWI IMI index as their policy benchmark. The second important structural trend that we have observed in recent years is the increasing realization that today's alpha is becoming tomorrow's beta. Investors increasingly recognize that a large part of portfolio performance can be attributed to systematic sources, and that these sources of return can be captured efficiently through investment strategy indices. So in response to this increasing demand from investors for efficient tools to capture systematic sources of return, MSCI has created a family of strategy indices. One important member of this family is the MSCI Minimum Volatility Index, that seeks to reflect the return of a particular equity market with significantly lower volatility compared to standard market cap weighted indices. So in this part of the presentation we reviewed the objectives of the MSCI indices and the main elements of our methodology that allows us to accomplish these objectives. So in summary, MSCI indices have three primary objectives. They aim to accurately reflect the equity opportunity set, they seek to minimize costs for passive replication, and also they aim to serve as fair benchmarks to assess managers' performance. And in fact, MSCI indices rely on four pillars to achieve these objectives. The first one is best practice methodology, as well as operational excellence. The second one is independent governance. The third is innovative new products, and the fourth pillar is superior client service. Over the last 4 decades, MSCI has been recognized as the preferred index provider for global institutional investors. And in fact, as we mentioned, many institutional investors are increasingly adopting the MSCI ACWI IMI index as their global equity policy benchmark. So with that, I will stop here and I will pass the microphone to Del.
Thanks, Dimitris. Before I dive into the expanded international strategy section, I'd like to spend a few minutes on who is BlackRock iShares and what is important to us. That is what's driven our success and relates directly to the thoughtfulness in index creation and the breadth of international index offerings the team from MSCI just shared. BlackRock has over 40 years of indexing experience. With that, we're the global leader in index ETF assets at $710 billion and lead this year with over $60 billion of net new flows on a global basis. Why is that important to you? 3 elements. Professional quality we'll start with. MSCI is the universal choice for international index exposures, and benchmarking our products to theirs is a key ingredient to iShares delivering well-managed, transparent, and precise exposures. Individual choice is extremely important. As advisors and institutional investors, you have unique investment needs and approaches. You're looking to extend your portfolio exposures beyond the standard indexes, looking for growth, diversification, and exposures to better manage risk. This is why in the U.S. alone we offer over 280 ETFs as investors access these products from around the globe. And then lastly, responsible innovation. There's 2 elements to remember here. The first is we listen to our clients and develop products that fit their needs. And second, remain steeped in investment research to deliver products that anticipate our client needs. The new investable market index ETFs, frontier markets, and minimum volatility ETFs are just an example of that. While Demetrius has already shared and discussed IMI, I think it's important to view investing through the following lens. This is a snapshot of where we've been. From left to right, it mimics how U.S. investors have indexed assets over time. I like to pay particular attention to the amount of assets, or rather the market cap, of the developed and emerging markets. This is mainly where international assets are invested today and consists primarily of large and mid-cap stocks only. We estimate that there's over $400 billion tracking the MSCI EFA Index and the MSCI Emerging Markets Index, with only a fraction being invested in small cap, and that's listed here in yellow. Small caps represent 13% of the total market cap, actually more than emerging markets. That's a sizable unintended bet over time, especially for many investors that are just simply looking for emerging markets exposure. For these reasons, the comments that Demetrius shared earlier, and the fact that small caps only represent 13%, or rather 13% of the international market space, and it is an underrepresented component of many investors' portfolios, that is why IMI has become very important to both institutional investors and advisors alike. I'd like to wrap up with just moving to frontier markets. Frontier markets today only represent 30% of the total market cap. But when you think of that 30 basis points, it's really important to put that into context and where frontier markets today is situated relative to where emerging markets was situated back in 1992. And it's listed on this particular slide. What are frontier markets? View them as early stage pre-emerging markets. Commodity-rich countries like Kuwait that have evolving capital markets. These markets represent over 30% of the global population. Why is there client interest in frontier markets? Untapped investment opportunity, high economic growth, and low correlation to mature asset classes. Interestingly, the market cap for frontier markets today, as I said, is roughly the same size as emerging markets back in 1992. You can see on the center of this particular chart how the emerging markets capitalization has grown from the late 90s to where it is today. That's quite sizable. And it's possible for the same, for frontier markets to experience the same. It's a market access issue. And the capital markets, a functioning capital market, is important to be able to have access to these particular regions. A couple other notes on frontier markets. GDP growth is forecasted to be in the mid 4% range. They also have a low GDP, a low debt to GDP ratio, and a younger population. The correlation to frontier markets to the mature assets, those being U.S. domestic equities and international equities, ranges to be between 40 and 50%, unlike developed markets and emerging markets, which are in the 80s to 90% range. The question we often receive is, are frontier markets more risky? The answer to that is, on a standard deviation measure, the answer is no. But the individual countries themselves are quite risky. The important component is that the correlations among frontier markets is fairly low. So in total, the overall risk is much lower than the individual components. And you can see this on slide 24. The Frontier Markets Index has a 3-year trailing standard deviation of 14.6%. As Dimitri said, there's international markets that are developing economically, but the equally critical factor for frontier markets is how do their capital markets function. You'll notice on this slide Pakistan and UAE. Pakistan is far better purchased in a frontier market given the capital market risk that Dimitri has shared than it would be in an emerging markets index. BlackRock has been managing frontier market investments for over 5 years with just over $600 million under advisement, primarily through commingled trusts for institutions. The Frontier Market Index was under development for just over 4 years because of the capital markets issues that have been resolved and allow us to offer this through an ETF. Investors are accessing frontier markets for diversification, which serves to lower overall portfolio risk. When we think about portfolio risk lowering, we should think about minimum volatility. The conundrum for most advisors today are clients that are near or in retirement and need equity exposure, but are concerned about equity volatility. Moving into fixed income just serves to lower the risk, but also serves to lower the expected return, and in fact, too much. This is what's given rise to interest in minimum volatility, new to retail space, but has been quite popular in institutional space. What is minimum volatility? Minimum volatility are indexes that are intended to provide similar exposures to their parent index, but with less risk. So it's constrained around company weights, sector weights, country weights, and style factors, so they don't stray too far away from the parent index. Since inception, the indexes have captured, as you see on the slide here, between 69% of the downside and 89% of the upside versus the parent index. The focus for minimum volatility should be on the risk-adjusted performance, because that is what they're intended to be offering. Why does minimum volatility work? Markets aren't perfectly efficient, and there's a tendency to overpay for high beta stocks versus low beta stocks. We're often asked, well, how would I use minimum volatility in a portfolio framework? And this is listed on the next page. This particular chart on the left-hand side shows a diversified portfolio consisting primarily of market cap weighted indexes. The chart on the right is simply swapping the market cap weighted indexes for the minimum volatility indexes, maintaining the same exact weight. The results are on the table on the right. What you will see, and I'd like to focus on the annualized standard deviation and the Sharpe ratio, which are most important. Annualized standard deviation, the risk goes from 9.84% down to 6%. That's 60% of the risk versus the market cap weighted indexes, with a Sharpe ratio that is 2 times higher. Maximum drawdown between negative 10.3% and a negative 3.6%. This is just an example of how financial advisors are thinking about using minimum volatility in a portfolio construction framework. Institutions, on the other hand, are doing this, and because of the risk reduction, that's 60% less risk, they view this as freeing up risk budget to where they can add additional investment to more risky investments, be it to hedge funds, private equities, or just simply taking on more equity risk with the expectation of higher return. And then in conclusion, I'd just like to show the global product view from iShares. How should we view this, and why are our products listed as such? We know that each individual investor is different, starting and providing very broad exposures, moving into regional exposures, and then into single countries. Selecting the right international exposure is about well-constructed indexes, professional quality transparent ETFs that fit together seamlessly. Individual choice is extremely important. We have clients that are building portfolios as they're looking to underweight exposure to Europe or to gain exposure to more commodity-centric or commodity-exposed countries. Or we have a lot of other clients that are simply looking to broaden their exposure, lower their risk, and doing so through very precise exposures. These exposures are provided through MSCI IMI indices at the core, frontier markets from a diversification standpoint, and more recently, the minimum volatility as an institutional tool for managing risk. So with that prepared, that concludes my prepared remarks, and I'd like to turn it over to Matt. Matt?
Thanks, Del, and thanks earlier to Demetrius and Diana. I think we covered a huge amount of ground there. It was a very productive discussion. Certainly lots to talk about in the Q&A. Before we do get into the Q&A, I'd remind the audience that as a participant in today's webinar, you can ask questions of Del, Diana, Demetrius, Dave, or myself using the Q&A window on the bottom right-hand side of the screen. And also a final reminder, a copy of these slides with the audio will be made available on indexuniverse.com a few days from now. And as an attendee, you'll receive an email from us announcing when those slides are available. With that, I'd like to turn it over to my colleague, Dave Notting, to ask the first question of the panel.
Thanks, Matt, and I'd like to thank the folks from MSCI and BlackRock for walking us through some of this. I mean, there's a lot we could dig into here. We're already getting a lot of great questions from the audience. I wanted to start off with one question that, frankly, we've been asked a lot in the wake of some of the changes other providers have been putting through on their indexes, and in the wake of BlackRock launching some new products. And I think it's a valid question, and that's, does this kind of narrow distinction between index selections really matter to sort of our core audience, which is really that buy and hold long-term investor or financial advisor? Does the difference between, say, the IMI or the non-IMI series, or whether Korea is in or Korea is out, how much does that really matter when you're talking about 10-year time horizons? Maybe we'll kick that off to the MSCI folks first.
Hi, this is Dimitris. Actually, index selection does matter quite a lot for institutional and individual investors alike, because some of these important index methodology decisions can have a significant impact on long-term return, on risk, and on cost. And we already discussed during the main part of the presentations that ultimately investors care about both accuracy and investability. On one hand, they want to select an index that accurately represents the underlying market. And at MSCI, we achieve that objective by having a transparent methodology, what we believe is a very robust market classification framework, but also by applying our methodology consistently across all markets, developed, emerging, frontier, and all size segments, large cap, mid cap, and small cap. So the result of that is that our indices cover the entire equity opportunity set without any gaps or overlaps. And I think that is very important for investors, for long-term investors who are looking to build a portfolio.
And Demetrius, while I sort of got you on the hook here, you were talking before about, for instance, the buffering system that you folks use to, say, manage the trading in between, say, a large, mid, and small cap portion of a portfolio, whether that would be U.S. equities or any other part of the market. That always strikes me as obviously a logical way to do it. I understand the academic justification behind doing it that way. But do you worry at all that there is any dilution of, for instance, something like the small cap effect, if somebody is really trying to get the small cap effect out of that part of their portfolio? How do you balance out how big the buffers are for something like that versus, actually staying true to the core philosophy? Because theoretically, you could just let the buffers be infinite.
Well, look, you hit the nail on the head, because very often in index methodologies there is a tension between what are effectively conflicting objectives. So on one hand, indices have the objective of accurate and timely representation of the market. At the limit, that would mean that indices should rebalance every day with no buffers. The moment a stock crosses a threshold, it should be promoted to the next size segment and vice versa. So that's one objective, to represent the market in a timely and accurate fashion. The other objective, of course, that we have is investability and replicability. So at the other extreme, you may want to delay implementing these types of changes for a long period of time to make sure that you don't have to suffer any reverse turnover. A stock that may have crossed the line today may cross it back the other way tomorrow. So that's where buffer zones come in, and ultimately it's an empirical question, and it's a question of judgment and experience and consultation with the investment community. And MSCI has been making those judgments in our methodology. In other words, balancing conflicting objectives for a very long period of time, and ultimately we aim to serve the needs of investors for accurate benchmarks, but also benchmarks that are investable and replicable.
And Dimitris, we had a question from the audience. Could you briefly explain the difference between buffers and packeting, since we're on that topic?
Sure. Basically, a buffer zone is a zone that delays the promotion or the movement of securities from one segment to the other. And this is the reason why we use this mechanism is to limit turnover and ultimately reduce replication costs. Packeting, obviously I'm not the best expert to comment on packeting. It's a relatively recent approach that's been introduced by a new index provider, and the idea there, the way I understand it, is to actually move only part of the market capitalization of a security and then wait for a period of time before you move the rest of the market capitalization of that security once it crosses a threshold. And the simulations that we've run actually show that that type of approach versus the buffer zones that we use actually leads to slightly higher turnover. It leads to more volatility in the number of securities. And also it leads to having the same security included in, at times, included in two different indices and in two different size segments when it's in mid-transition, if you want, from when one packet has transitioned but not the other. So that would be my, if you want, general comments about the differences between buffer zones and packeting.
Sure. I wanted to bring in Del here. This is a question I hear a lot when people are discussing the MSCI methodology. Del, do you think investors or a lot of investors are missing out on Canada because it's excluded from EFA? And do you find that worrisome at all, or how do you work with clients to make sure they're not missing part of the opportunity set?
Sure. As we think about investors missing out on Canada, while yes, it's certainly not a part of the current of the EFA index, it is something that clients are accessing actually through iShares Canada ETF. It's about a $4 billion fund. At the same time, that's one of the reasons why we've launched the IMI series, the iShares Core Total International Stock ETF, IXUS. In that particular instance, you do get exposure not only to Canada, but you get exposure to the large and mid-cap and small-cap realm. So point certainly taken, investors have seen that and have been buying it through a single country fund, and by offering broader international ETFs, this is just one way where you can get all of that exposure in one single ticker. If I could,
sorry, go ahead, Del.
Yeah, if I could, I just wanted to comment just for a second on the question that was asked previously, just around index provider and the differences for long-term investors. And the conversation that we're often having with clients is that while clients are long-term investors, their clients often have intermediate needs. And that's where you do find those differences in quarter-to-quarter and month-to-month performances where we do need to rebalance or liquidate holdings for one reason or another. So while the time horizon might be fairly long for many of the advisors today, there are needs that are intermediate. And so when we think of some of the transitions that happen within indexes, when we think of Pakistan, and things such as that. That's where, while being a long-term holder is important, there is certainly intermediate need that could trump the long-term nature and put a spotlight on index construction. So I just thought I would add that in there.
Well, Del, that's actually kind of a great segue to the question I was actually just about to ask anyway, which is, the product moves that you've made here, creating the core series, which, I applaud. I mean, you're offering low-cost exposure to an index series that we think is great. That's all well and good. But are we starting to see a segmentation in your business and in the ETF market where some products are meant for some folks and some products are meant for another? Because if I look at, for instance, the two emerging markets ETFs now in your product lineup, you have this new one which is based on the IMI series, which, certainly based on the slides we saw from Dimitris, look like a better mousetrap version of that kind of exposure, and it's cheaper. Shouldn't everyone be just switching from the older series, which is not the IMI and slightly more expensive, to the new one, or is there really a client segmentation that's happened here?
It's a good question. You can think of it like this. The IMI indices certainly are going to appeal to a certain audience, perhaps to a buy and hold audience, or one that doesn't have a bias towards wanting large and mid-cap stocks. When you think of the EEM in particular, it's one of the most liquid traded securities that exists today. I view that same comparison to the S&P 500, where the S&P 500 years ago was defined as the barometer for the U.S. market. We all know as practitioners that since then there have been other indexes that have been launched and have increased in popularity, but they really haven't supplanted the S&P 500 as that barometer. So you could almost view EEM in particular, or the standard index offered through MSCI, as kind of the standard and that proxy for emerging markets, where broader access is something that was only a matter of time, and it's a market access issue as products continue to be developed and indexes that track them that can be investable, that are investable, are developed. I think that best explains this particular drive towards having very liquid proxies for emerging markets, in this instance as well, another alternative that provides broad exposure, well constructed, and very transparent.
Yeah, Dimitris and Diana, I wanted to ask a question about, you had a nice slide there about sort of the hidden costs of indexing and some of the turnover-related costs that are in there. From a end client's perspective, how are investors supposed to make that evaluation? How are the advisors on this call supposed to determine between the various, broad-based market cap-weighted indexes, which will have, higher or lower embedded internal costs? What should they look at?
Well, first of all, I think it is important to highlight, to emphasize again, why so-called hidden costs are extremely important and relevant for investors. And they are important for a very simple reason. They eat into the net return that the investor can enjoy. So if the index has very high turnover, it changes a lot, then any product based on that index may have a low expense ratio, but at the end of the day, the product will need to trade a lot to follow the index. So, and that trading could eat into the net return for the investor. So that's why high turnover can lead to high, can have a negative impact on the net returns that investors enjoy. So as I mentioned during the talk, we do use buffer zones extensively to reduce turnover and replication costs. But that's not the only tool that is available to us and that we use to keep replication costs low. Very clear and implementable, if you want, treatment of corporate events with very low error rates is also extremely important, because that means that investors do not need to do reverse turnover or unwind certain errors and so on, and that again helps to keep replication costs low. Another tool that we use is liquidity screening. And again, we place quite a lot of emphasis on making sure that any stocks that are included in our indices are liquid and investable. And to achieve that objective, we don't use a single liquidity measure, but in fact we use 3 complementary liquidity measures. We look at short-term liquidity, how liquid the stock has been recently, in the last 3 months, for example. We look at medium to long-term liquidity during the last year, and also we go a step further and we look at frequency of trading. So it's not sufficient for a stock to trade once in a while in big lumps. It has to trade fairly evenly and has to have good frequency of trading as well to pass the liquidity screen. So that's another way to help keep replication costs low, ensuring that the stocks in the index are liquid enough and investable enough.
So, since we're on the subject of costs, I thought this might be an interesting way to sort of talk about the relationship between the index provider on the MSCI side. You're coming up with effectively a theoretical list, and then the job of folks like BlackRock and iShares to turn that into an actual working product. Right? They're the ones that actually have to go out into the market and buy those stocks and get them into a portfolio and manage them well. And so I thought, Del, maybe, we just heard Dimitris talk a little bit about the intent of these indexes to minimize costs, to be easy to invest from the perspective of somebody like BlackRock. What's the best way for an investor who's sitting here looking at a bunch of products from a bunch of different issuers, sometimes tracking the same index, sometimes tracking similar but different indexes? How can they evaluate whether or not you guys are actually doing a good job? I think that's a hurdle we get asked questions about all the time.
Sure. As we think about measuring performance between ETFs, I'll give you a couple ways of thinking about it. And Dimitri shared some very key comments, which are the cost of managing an index portfolio in many instances are not seen by the underlying investor. It just shows up as lower cost because of the transaction costs inside. When we think about measuring performance, simply I would think of longer-term performance differential, and I would think that being combined with shorter-term performance differential, and that's the NAV performance versus the index. And the reason I would look at those two combined is it gets at the practical experience of an investor. Long-term performance differential between the index and the fund will give you a long-term trend of how well it's tracking that particular index. The shorter term is extremely important because that's the reality of what an investor is faced with today, with investing new cash flow and divesting cash flows at the same time. So those shorter-term performance differences are extremely important because that's reflective of what an advisor or an institutional investor is having to deal with. So I'd like to think of it combined and looking at performance differential both on a long-term basis combined with a short-term basis, because the short-term view gives you a sense of practicality and what's happening today, and longer-term view is giving you one of how the manager is doing over time. We can certainly discuss more what would call sophisticated ways of doing so, such as measuring the volatility of the difference in performance, and there's certainly value in doing that, but I would start with that particular simple measure at the outset.
Yeah, I definitely agree with that. I wanted to transition in the last little bit, past the sort of basic market cap weighted beta into some of the what you might call better mousetrap approaches, eating into that alpha section that Dimitris showed, and specifically on low vol. We've got a lot of questions from the audience on low vol, and I guess I'd start with you, Del, and then hear from MSCI. Are you worried as there's more and more talk about low volatility and the premium attached to low beta stocks that will disappear? Will that factor be, eaten up by its own popularity?
That's a question that we've gotten from clients as well. And in fact, we're not concerned about that. And in fact, there was a study that we did, and it was a fairly straightforward study, and it's posted on the blog, which simply looks at the S&P 500 and goes back in time to 1959 or so. And it simply takes over certain segments and certain periods. It ranks those below 50% in terms of their beta and those above the 50% threshold in beta, and it just calculates the average performance of those cohorts. And in going back in time and looking at periods over time, you don't see that dissipate over time. While there are going to be markets where the minimum volatility may underperform, that's expected on a total return basis. That will and can happen. More importantly, though, is the risk-adjusted performance. So again, looking back at the S&P 500 was an easy way, and just simply saying, show us those that had low betas and those that had high betas, and simply calculating those returns. And you will find that there are superior Sharpe ratios on all of those cohorts and all of those periods. So it's not something that we think that is going to dissipate, but instead is a persistent phenomenon, as there is a bias over time of high beta stocks versus low beta stocks.
Demetrius, any other thoughts there?
Well, I think specifically for minimum volatility, it is important to bear in mind that the main objective of the strategy is to reduce the volatility of the benchmark, the risk of the benchmark, and it has done so consistently in previous market cycles. In fact, I think it is important to point out that the MSCI minimum volatility indices were launched in the early part of 2008, just as we went into the financial crisis. And during the subsequent financial crisis, these indices were live in production. We don't show back tests. We actually had a live index back then, and we noticed that, as expected, the live minimum volatility indices in the second half of 2008 outperformed the market in relative terms. Again, more recently, during the Eurozone crisis and certain periods such as the third quarter of 2011, where we had a significant drop in equity markets, we see some degree of relative downside protection with minimum volatility. So over long periods of time, historically, minimum volatility has outperformed the market by a small margin, but where it has really added quite a lot of value is through volatility reduction and through relative downside protection in periods of crisis. And I think viewed in that light, not so much as an alpha product, but more as a systematic way to reduce the risk of a benchmark, I think that is perhaps a more appropriate way to view this strategy.
Right, that makes sense. I think we have time for pretty much one last question, and maybe I think I'll toss this one over to Del. I think a lot of investors get a little confused when they're thinking through their index decision process, particularly if they're what we see as part of a trend towards real macro-style management at the advisor level. Instead of, say, just buying ACWI, they're actually being a little more targeted with their exposure. They're making their own calls about how much emerging markets exposure or even country weighting. And I think that it's easy for them to get confused. I mean, even within a single fund family like the iShares product line, and even within, say, emerging markets, there are products in your list from multiple index providers. There's S&P products, and if they're doing sector funds, there's FTSE and Dow Jones products alongside other people's. Do investors need to be worried about sort of having brand loyalty to a specific indexing methodology? I mean, Demetrius, I think, made a very good point in his description of the core proposition at MSCI about non-overlapping buckets and things like that. How much do investors need to be comparing and contrasting different styles of indexing from different providers if they're making these kinds of macro decisions for themselves?
That's a super question, and I'll wrap up in saying that we find clients using the broad-based indexes, and I'll get to the component around the macro themes. Broad-based, staying within a single fund family makes a ton of sense. No gaps, no overlaps, and the countries will move intra-index very, very nicely. We have a lot of clients doing that, and for those more tactical and macro plays, they will use an index that simply put, best represents the exposure that they're looking for. So they may use, say, for example, the S&P Global 100 to overweight that particular sector. Or if they're looking for Brazil, they may do so with MSCI. I would say at the outset, my default position would be to stay intra-index family where possible, and do so especially in the broad-based indexes, and then if need be, move outside of that with the more tactical plays. So that would be the way that I'd answer the question. Broad-based, stay intra-index if you can, but with your tactical plays, it's certainly fine to be using different index providers with countries, etc.
I think that's extraordinarily solid advice, and with that, we've wrapped up the full hour here. for this webinar on building institutional caliber portfolios with ETFs. I'd like to thank my colleague Dave Nottig, for helping to moderate this session, and send out a big thanks to our panelists, Del Stafford from BlackRock iShares and Diana and Demetris from MSCI. I think this was a great session. Thanks to all of the audience for attending this webinar. I hope you have a very good afternoon and a very good week. Bye.